And we're live. Hey everyone. We're back again. I've got Mark Willis with me. I was just speaking with him, but I think he clicked the wrong button. So hopefully he'll be back by the time the introduction finishes. And we're going to get into a big talk today, not only about the bank on yourself methodology, but we're also going to be talking about annuities and using annuities as part of a small business strategy, retirement strategy. I see Mark just popped right back in. So we're going to join here in a second. And without further ado, let's get this ball rolling. So, how can you learn more about buying, selling, financing, and managing small? I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win. All right, everyone. Welcome. Yes, we got the technical glitch fixed here in time. Mark is back with us. How are you doing today, Mark?
Hey, doing great, David. Glad to be here. Thank you.
Awesome. So today we're going to be talking about annuities, and for anyone who has not seen one of Mark's prior appearances, I'm just going to flip over here. If you go to newbankingsolution.com, it's a special web page that has an hour long webinar that Mark and I recorded about the bank on yourself insurance strategy. And then underneath, there's the 5 different videos from the different live streams that Mark has done over the course of time. So this, Mark, is your 6th appearance on the live show, in addition to the webinar we recorded, which kind of covers the basics of the strategy. And we got into a lot of different topics about how people can use the bank on yourself strategy in small business and their personal life, etc. If I had to give you 2 minutes to explain what it is for anyone that's new, what would you say?
Well, for those that have never heard of this before, strangely enough, in all of the financial universe, David, there's a weird 200 plus year old financial vehicle that's grown every year, guaranteed outside of the stock market. It's never lost value in every major market boom or bust. It's dividend paying whole life insurance of all things. It can, again, build a secure place to park cash. It can provide a stream of income without taxes due in retirement or even before retirement. And you can use it like a bank, almost like a line of credit to yourself that you can use and continuously get uninterrupted compound growth, even on the capital you borrowed for major purchases. So think about how that might work in your business, whether it's equipment financing or buying a company or personal vehicle or sending your own child to college. There is no prohibited transaction, so the options are fairly infinite when you think about it. But it has to be designed properly, and you want to make sure it's designed by someone who knows what he or she is doing. You don't just want to work with your uncle who's got an insurance license, and it's not a good fit for everybody. So make sure you've worked with a bank on yourself professional. That's what myself and several other colleagues I work with have been trained and certified and authorized to design these things properly and to manage them well for years to come. But in 2 minutes or less, that's what it is. It gives you
Yeah.
a permanent line of credit, you might say, to yourself that grows in value every year.
And so as a person who has bought stocks and mutual funds before and then had them go down in value, and I may not be the only person ever to have had this happen to me, but this is what attracted to me to the whole fact that this is a contract with guaranteed increases in value over time. It never
Yep.
backslides. Once your year has gone by and a dividend has been issued by the life insurance company and the cash value of your policy goes up, it can never then go back. And just the fact that I'm in control, I'm the one who gets to decide if I'm going to borrow against the policy or not. A ton of features there that kind of wrap in what's great about investing in markets and what's great about maybe investing in things like real estate. And it kind of takes all of these great attributes from these different categories and kind of puts it together, with the added benefit of, if I should pass on, my family gets to inherit money tax free. So if people are interested in learning more about this, and I'm a fan, I use this myself. That's why Mark is the sponsor of my channel. Go to newbankingsolution.com, because those videos are all on there, like I just pointed out, and spend some time learning about it. And there's a link there to click if you'd like to have a brief talk with Mark about whether or not this is something suitable for you. People are always thinking, well, I have this particular situation. Is it right for me? The best thing to do is just talk to Mark. So, life insurance, to get to today's topic, you pay a premium,
Mm-hmm.
and then over time, the value of the asset grows and grows. If you pass on, there's a death benefit. And, between now and the time you pass on, there's advantages. Like you just mentioned, you can borrow against the policy, it gives you liquidity and things like that. Um, but some people will also be interested in using these insurance products as vehicles for financing their retirement. And so we've talked a lot before about how you can borrow money against a policy, um, but that still is a loan, that
Mm-hmm.
that needs to be paid back. Either you pay it back yourself, or it gets paid back when you pass from the death benefit proceeds. But life insurance companies also offer another kind of thing, this sort of the mirror image of insurance, which is the annuities. You want to explain to us what an annuity is in simple terms?
Sure, and it sounds, sort of like you're dealing in a world where, these are all arcane, well, let's say archaic, I should say, strategies. What good do they have in today's modern world where, we're dealing with such complex financial struggles, problems, and yet there's, I think, a space for something called the Lindy effect. The Lindy effect is the longer something has been in existence, the more likely it is to exist into the future. So, it's the reason why I believe the iPhone will be superseded, or succeeded, I should say, by the chair, and why I think the book will outlast the Kindle.
Okay.
Strange as it might sound, at this point, I think we're going to have writing tablets will outlast the iPad. Why? Because they've existed for thousands of years. And so when you think about what's going to last for your lifetime and for the lifetime of maybe your spouse or your children and grandchildren, you want to think about financial tools that weren't invented yesterday. You want to find tools that have stood the test of time. And I figured I'd share my screen a couple of times here today. There's a tool that, or there's a museum just outside of Chicago, just down in Hyde Park area. And I lived in Chicago for 11 years, still live in the area here. And I think it's worth showing. So I took a picture of what I saw here. It's an old, it's a museum for nerds. Let's just say most museums are. But for me, this is like ancient Egyptian and Mesopotamian and like biblical archaeology stuff from like ancient times, Hezekiah's time and so forth. And so if I share my screen here, this is a picture I took of one of the, I guess, documents on the wall of one of our museum walls here at the Ancient Oriental Institute there in Chicago.
Okay.
Now, as you can see here, there's a kind of a brown parchment with some weird, cool writings on it, with next to a bunch of clay tablets and more. But what I was surprised by is what the placard said underneath this long, 20-foot long parchment. Wouldn't you know, it was an annuity contract from 365 BC.
Wow.
Now, everyone has a shock on their face when they see this, and they wonder, well, what in the world was an annuity doing back then? And that's what I want to bring to your business owner's attention today, because I think annuities still have a huge part to play in our lives. In fact, if you have Social Security, you already have an annuity.
Okay.
Annuities are nothing more than a permanent lifetime income that's guaranteed for life. And for many people who deal with uncertainty, especially business owners, having a stream of protected income for at least a portion of your retirement could make a lot of sense. Before 1974 in the United States, we had mostly pensions in most of the company jobs you might get. Now, since ERISA was passed, the Retirement Security Act in the 70s, there's now been a proliferation of qualified plans. That would be your 401ks, your IRAs. In Canada, what are the equivalents?
RSPs and our equivalent of Social Security is called CPP. So basically an annuity is a monthly payment until you pass on.
That's right.
And then so the other question then would be, how much, and that would be determined by how you acquire the annuity. So in the
Yeah,
case of Social Security or CPP, it's all based on how much you paid in over the course of your
right.
working life. But once you reach that point where you start to take money out, they kind of fix your amount. And then
That's right.
it doesn't matter how you can't out survive the Social Security or the CPP. You're just going to get that amount of money until you pass on.
You think about it, like even if you had $1 million, even 10 million, but let's just stick with $1 million, nice easy number. How would you know precisely what the right amount of money was to pull out of your $1 million bucket? Again, 5 million, 10 million, 100 million, it doesn't matter. What is the safe amount to pull out of your retirement accounts such that you won't outlive the money? It's impossible to calculate that number because none of us know how long we're going to live. Annuities solve that problem because they promise, the guarantee says that even if you run out of money, you never run out of income. And for a lot of business owners, cash flow is king. In fact,
Right.
I would say all of us need and rely on cash flow. It's the oxygen in our business. That doesn't stop just because you retire or you sell your business someday. So let me give you a couple of quick stories. Then I've got some stuff we can get into here,
Sure.
some slides and more if you want to go there, David. This is of course wherever you want to take it. But you can have an annuity integrated into your retirement plan. So have a business owner who has a 401k for his couple of employees, but he wanted to sock away a little more than the minimal amount he needed to fund the 401k for his employees. They were matching like 3%, and so that was a little bit for the employees to keep them motivated and to attract the right talent. But he was the business owner, and he was putting a lot of risk on the line to start this business. It was his entire life, so he wanted a larger deposit to go in than just 3%. And of course, the qualified plan rules say that you basically can't show preference for different employees. You've got to have a similar contribution to the executives as to the janitor that works at your
Okay.
business. So what can you do? Well, there's several different plans. We set up what's called a cash balance plan as a hybrid. So there's a 401k that we have for the employees, and the employer and the owners of the business are able to dump in, get this, several $100,000 a year, a little over $300,000 going into a cash balance plan. And that cash balance plan is being funded with cash from his income. So he's able to deduct a little over $300,000 a year from his taxes, saving him a ton of money on his IRS love letter every year.
Okay.
And where does that cash balance plan go? What is a cash balance plan? Well, it's an annuity is what it is. So we're funding an annuity with $300,000 a year. And can you imagine the kind of stream of income he'll eventually be able to take? This is a perfect example of how annuities can fit into the business owner's story, saving him on taxes now and giving him a permanent lifetime income in the future.
So just so that I'm clear, that money is going into like a savings account to buy an annuity when he retires, or is that money going to the insurance company every year to grow in value until he retires and then it starts to create the cash flow?
Yeah, great question. It goes into a deferred annuity, which
Okay.
receives money every year. So he's funding an annuity with his payments. And it goes into, it's called a cash balance plan, but the tool being used is an annuity. And he's adding premium to that annuity each year in the tune of several $100,000.
Okay. And so like let's be clear here about the annuity, because when people hear that the annuity is guaranteed for as long as you live, one of the first things I think of is, well, what if I put in X amount of dollars and then I live for a really long time, and then I'm going to get potentially way more out of the annuity than I put in? How is that sustainable for the insurance company?
Yeah. Well, it's all a matter of numbers. It's using the same math that life insurance products use. They're using actuarial science. It's the idea that, hey, if 100 of us, there's an old joke about 100 women show up for a luncheon every year. And at that luncheon, they all put $1 into a hat and say, whoever shows up next year gets to keep the money. And so these are elderly women. So unfortunately, 1 or 2 of them pass away in the first year. So 98 people show up the next year. They put another $1 in the hat, and so on and so on. As long as you're alive, you get to play in this game. And the winners, get the hat's proceeds. And this is sort of how actuarial science works, only at a very large scale. So they don't know how long I'm going to live, you're going to live, but it's scary how accurate they can be on a high level, like on an actuarial level. How many of us are going to live to be 89 versus 99 versus 109? And so they calculate their reserves in that regard. It's one of the most predictable sciences out there. Now, could they be wrong? Sure. But they've got cash on hand to cover that obligation for an individual versus, let's say it's just little old me, solo, trying to figure my own life expectancy out. I don't have the power of actuarial science and something else called mortality credits, which gives you and me the chance to live on the back of the insurance company if we outlive our life expectancy. On the other hand, some people will tell me, well, Mark, wait a minute. That sounds like if I die too young, I might be getting a ripoff. Okay, I guess so. You could have maybe had a little higher rate of return, let's say, in the stock market if the market was up. But one thing that's been done in the last probably 30, 40 years with annuities is they will still pay you a death benefit. So if, let's say that I have $1 million in my annuity, I'm able, let's say, to take that income out. But let's say I died 1 month after I retired, God forbid. My family would still get the giant chunk of money, that $1 million or whatever I hadn't yet spent. So the annuity companies are willing and able to make those arrangements to make sure that if you don't outlive the money, you get to leave a legacy to your family.
So my first thought when I asked myself the question, how, about what if I live extra long, how does a company, able to afford that? My first thought was, well, someone else is probably dying earlier. Right. And so because they manage it as a pool of people, they're working in a world of averages. Right.
Yes,
And
that's
so
right.
when you mention things like there are products out there that allow you to recoup some of that annuity cost if you happen to die earlier,
Mm-hmm.
I mean, these are all the sort of dials and switches that can be applied to these different annuity policies when they're set up.
That's right. That's right. Each one of these, it comes with, pluses and minuses, each one of them. And if you wanted, for example, I just did a podcast on this on our show, Not Your Average Financial Podcast, just last week. But we talk about what we call the Bank on Yourself Plus strategy. So this is according to, using this strategy, if I may, let me kind of walk through what this would maybe look like for a business owner, because I think this will spark some imagination for some people. What's the big problem with annuities? So the big problem with annuities, I mean, with all the advantages of guaranteed income, that's awesome. But what's wrong with it? What's the catch here? The catch is they're not big liquid buckets of money that you can use for your business or for your life. So at the beginning of this conversation, David, you and I talked about how Bank on Yourself type life insurance policies are liquid. They're a big bucket of money. They're a contingency fund you can use to help your business through an emergency, help your family weather a storm, repair the kitchen, send your kid to college, whatever you need to use the money for. Annuities are not liquid in that regard. They're basically set it away and get ready for retirement someday. All right. So what if we could combine the power of both? And this is what Bank on Yourself Plus allows us to do. So in this world, what one might do, let's say you're a business owner and you're able to pack away, pick a number, 30 grand a year, 100 grand a year, 5 grand a year, doesn't matter. You start packing away your money into a policy and it grows to $1 million. And for the duration of that funding period, you're in your working years, you're building your business, you're selling your widgets, and maybe you're even borrowing from that policy a few times to get your company cars or your widgets, you need some inventory purchased, or you got to pay off an old business loan or whatever. So you've made it through your 25 years or 30 years of work, and now you sell your business or whatever, and you have this $1 million in your policy. Use that number for a case study. What can you do? Well, you can live on that $1 million. But again, even a Bank on Yourself policy, as cool as it is a finite amount of money. And now we're back to the same problem of how long am I going to live? What's the safe money I should take out of my Bank on Yourself policy so I won't outlive my cash? That's you might say, the hidden problem of Bank on Yourself is I still don't know how long I'm going to live. What can we do? Well, there's a little known form of transfer in the tax code called a 1035 exchange. And most people have heard of the 1031 exchange, which is how you go from one real estate property to another here in the United States. There's probably something similar in Canada. Do you know by chance if there's a way to tax-free transfer from one real estate property to another? I'm putting you on the spot here,
Uh,
David.
I don't think there is.
Okay, all
Um,
right. Well,
there's ways to move assets between corporate entities that are under mutual control and stuff like that.
okay.
But back in my business broker days, this was one of the reasons why businesses changed hands so much more frequently in the States versus Canada, because the 1031 exchange at one point historically was applicable to small businesses as well, and I
Oh,
believe
cool.
that's changed in the last few years. But it was possible for people to kind of sort of swap and trade and buy, sell, and get into bigger businesses. But no, it's. I think though, within an investment envelope, like inside, registered plan or anything, yeah, there are options. And I mean, if someone's in Canada, you can direct them to as well. If people reach out to you to someone who can help them there with this.
So in this case, we've got a 1035 exchange, which
Okay.
still allows us to move from life insurance to life insurance tax free. So in this case study, we've got a guy with $1 million, and he could probably pull safely for about 30 years out of $1 million cash value. He could live for 30 years in retirement, probably spending about 50 grand a year out of his life insurance, tax free. Now,
Okay.
that's way more than what 401k experts would tell you to pull out of a 401k. Typically, you're going to look more like 30,000 bucks a year out of a 401k safely over a 30-year period. All right, so we went from a 401k, $1 million in a 401k at 30 grand a year of retirement money. We upgraded to Bank on Yourself, and now we have a tax-free estimated at about 50 grand a year income. And that's awesome, but we still could outlive our savings because $1 million is still only just $1 million. So what else can we do? Well, here's Bank on Yourself Plus. At retirement, a lot of our clients are choosing to transfer 1035 transfer tax-free into an annuity, their cash value. So the cash value from your life insurance becomes the funding source for the annuity with no taxes due. And our recent calculations showed that if you bought an immediate annuity at the point of retirement, you'd have an income of roughly 71,000 bucks a year. Now that to me is more than 50,000 bucks a year. At
Right.
least my calculator seems to say so. And it's sure heck double more than the 401k was going to provide. And this is all without any market risk or other problems in terms of fees. There's no fees on this strategy. There's no market volatility or sequence of returns risk. And maybe most important, the biggest problem of them all, how long am I going to live and how long does this money need to last?
And so that 71,000, is it still tax free, or are there tax
Oh, great
consequences with
question.
that
Yeah,
annuity income?
one of the points of annuities is they don't have, in the United States anyway, they don't have a pure 100% USDA organic, totally income tax-free income.
Okay.
Depending on your age and detail, this is something called the exclusion ratio, so it gets a little complicated. But if it's going from life insurance, which is tax-free in the United States, we can get the money out tax-free. It goes to an annuity, most of it would be tax-free, but it would be taxable each year a little bit as you're receiving the income. What I like about this advantage is, let's say you're being paid 71 grand a year, maybe only pick a number, 8,000 bucks is taxable. The
Okay.
rest is not taxable. So that 8,000 bucks is showing up as taxable. What is, your tax bracket? Let's say it's 25%, 2468. So you'd pay about $2,000 of taxes to pull out 71 grand of income. Again, talk to
Okay.
your accountant to get all these details specifically, but this gives you an idea of just how tax advantaged annuities can be, even if it's not totally tax free. One exception to this rule in the United States, of course, the Roth IRA. If your annuity is inside a Roth IRA, si bueno, man, it's 100% tax free.
Yeah, because it's inside that envelope. And I mean, the stuff that you're talking about right now just sort of highlights the whole thing that I like to caution people about retirement planning information from the internet, is that every person's situation is unique, and you really have to have an advisor who sits down and looks at your specific stuff, because all of this is going to be impacted, I would imagine, by people's other income, other investments, other things they could have going on in their life outside the scope of just what we're talking about today. Um, And of course, this isn't an all or nothing kind of thing. Like it's not a decision of I'm going to put all of my money that I have access to into an annuity. I mean,
That's
this
right.
is often part of a plan that has different sort of aspects and
Hmm.
I've heard you speak once about how there are different advantages to having multiple bank on yourself policies. And so in this scenario, if you had multiple policies, you could choose to convert one of them into an annuity.
That's exactly right. I
Yeah.
preach all the time. Having that portfolio is crucial. I recommend folks have at least several so you can ladder which one you can kind of place in one after the other, what you want to do with them. We've got several policies. You want to make a name for them. Like here, these are going to be the business policies. These are going to be the family policies. Or you could say, this is going to be the car policy, and this is going to be my taxes policy. But they all become retirement policies ultimately. And so you might say, hey, I've got 6 policies. Let's make 3 of them annuities, doing the
Hmm.
bank on yourself plus strategy we just described. Let's leave the other 3 liquid in case we have an emergency throughout retirement years. So that's an incredible tool. And by the way, again, just coming up with creative ideas here. If you sold your business at a profit, working with David and many others, you can have a big windfall when you sell that business. Now, maybe you put that money into policy loans that you've taken against your policies over the years and wipe clean all the loan balances. Now you've got, instead of, a loaned against policy, you've got a fresh, clean cash value that you can transform into an annuity. And you can move on from there. If you don't have a policy already set up, or if you have other desires, you could use that windfall from the sale of your business to fund an annuity upon the sale of your practice. And you just created for yourself a golden parachute that'll last as long as you live, helping you into your golden years.
Mm.
Now, I had some numbers I wanted to share, but
Yeah,
before I
sure. I
jump into
see.
all that, any
Okay,
other
I see.
comments?
Well, there aren't any in here. And again, if you're watching live and you have a question, just pop it into the comments, and we'll deal with it here as we go on. But I saw you load up something in here. You want us to take a look at this?
Yeah, there's certainly a lot to consider here, and obviously there's been some updates in the market. What we're looking at here is a chart of 3 different scenarios. Let's say that you were in 1998 going to put some money into an account, and you could choose let's say a CD, you could choose the stock market like the S&P 500, or you could choose what we're calling a fixed index annuity here, which is one of the options you can pick from among many annuities out there. Now, again, we ran this through the end of 2016. Clearly, there's been some major market updates since then. So I can
Right.
show you an updated version of this sometime. But this just proves a concept. It's not meant to, give any kind of advice or whatever like that. So as you can see, in 1998, the market was roaring with the tech stock at that time. Tech bubble was booming. And as you can see, the red line, the S&P 500, was jumping up like fireworks here. The blue line looks as boring as you can imagine, and that green line was doing okay, but it was definitely underperforming the red line.
Mm.
And now imagine how it would feel on the green line in 2000. Just think about that. You're at the barbecue and your buddy is saying what kind of crazy returns he's getting on his Enron stock and his pets.com stock and all of that. And your green line, the fixed index annuity in this case, is only performing, let's say, 3/4 of what the market is doing, which is,
Right.
according to what I see here about what it's doing. This is the fixed index annuity world. You're not going to get all of the upside of the market when the market is going up. You're going to get some, but not all. But what happens next is most important. In 2001 and 2, the market literally gets cut in half.
Mm.
Worst experience of many people's lives. They have scars from it even to today. When I meet with clients, the feelings they have from market in 2001 and 2, and again in 2008 and 9 are still very raw. They lost literally half of their life savings, and I've heard the phone calls. I've met the people, and yet the green line, the fixed index annuity, how's it doing in
I
those
know I
years?
know people, Mark, that had to delay their retirement by 4 or 5 years.
Yeah,
They
yeah.
were planning to retire around this time, and they had to put it all on hold because the value of their accounts just went down so much.
Imagine how you'd feel at the barbecue in 2002 if you were on the red line.
Mm.
You know, now imagine what it would feel like if you had played the green line and you had given up some of the upside in the good years, but you were protected from losing a penny. If for folks that can't see this, the green line is not going down when the market crashes. It stays flat.
Yeah.
And then it resumes its upward march when markets recover the following year. This is and obviously the green line inches out against the red line. But let me ask you a question, David. If we were to keep playing this chart even further into 2024 when we're recording this, is it possible the red line could have exceeded the green line again? Probably. Yeah. And let me ask this next question. Which of these rides would you rather take over the next 20 or 30 years? Not knowing where the market's going to go.
Well, listen, that 2000 and 2001 tech bubble period, that was just after I graduated from university. And this was when I was starting to have savings from my first career, and I was starting to put money into different investment vehicles. And I put money into some of those stocks that had great fortunes leading into that whole tech boom. And then on the downside of that, I lost money in some of this stuff. And when I said earlier that losing money on investments has shaped the way I look at these things, this is what we're talking about. And so, as I am approaching 50, now I realize, hey, I need whatever money I'm saving, I need to have access to it, not 30 years from now, but like 15 years from now. I realize that the time frame is just not there to recover any huge losses. And so as you move through time in your life, you become more and more risk averse just because you realize you're running out of time to recoup losses again. So, I mean, for me anyway, the green line looks great. The blue line actually doesn't look that bad either.
I don't mind. Yeah.
Right.
Yeah. I mean, which year? And look at 2001, for example. Of the three colors, which one grew? It was the blue line that grew in 2001, right? The only one that, and that's the whole life policy. That's your, CD accounts. Those are the fixed accounts that just grow guaranteed every year. So you're right, David. And take a look at the time it takes. Just picking 2 years at random. Look at the year 2000, the red line in 2000 versus the red line way over here in 2012. How long? It took a decade, 12 years, a dozen years just to break even and exceed that again. Can any of us really afford a lost decade or 12 years like this? I don't care if you're 21 years old. If you lose 12 years of compound growth, that's money you'll never see again. In fact, it's worse when you're younger to lose money because that's money that could have been greater in your later years. So it's actually not as bad when you lose money when you're 60. You just don't have as much time to make it up again. None of us have 12 years. I don't care how old we are or young we are. Now, this is sort of
that red line, Mark, it says S&P 500. Is that just the value of the index, or does that take into account like the management fees someone would have paid if they were invested in a S&P 500 mutual fund?
Great question. This does not include any fees on that fund. It's just assuming a index fund that you're tracking with no fees or taxes, by the way.
Right. Okay.
So yeah, you're right. This could obviously turn out a lot different for each person, but I want you to just picture which of these rides look like a ride you want to take with your money, and which one, I call it Mount Retirement. Which one looks like you're climbing a mountain versus having a roller coaster ride. So climbing the green line gets you up to the top of Mount Retirement. But I've always told folks, where do you want to plant your flag? Is it the top of the mountain? Most people think yes. But I would actually say, and this is surprising, but National Geographic says that 85% of deaths on Mount Everest are actually descending the mountain. Not going up, but coming down is where most of the deaths occur. And there's a lot of psychological, probably physical reasons for that. But coming down Mount Retirement is where most of the devastating losses happen. If you think about it, when markets crash, you are also spending that money in the same year. If you're in retirement, if you're 77 years old, it's not like you can just wait it out. It's not like you can just not eat groceries that year or whatever. You've still got to be able to provide for yourself, whatever. And this is where I think the annuity shines. So let me kind of take us down this road here. So here we are. I don't know if you can see this new chart here. Yep. Okay. Yep. So what we're looking at now is, imagine for me that you had 500 grand you're 55 years old, and you put 500 grand into a fixed index annuity. And let's say you waited until you were 60 years old to retire. Now, where's that 500 grand coming from? Again, that might be a 401k. It might be an IRA. You might have a cash balance plan like we talked about earlier. You might have a whole life policy that you decide to 1035 exchange into an annuity. It could just be cash in your bank account with your business that you want to fund a retirement account for yourself. But for some reason, at age 55, you dump in 500 grand and you wait 5 years to retire. Notice that 500 grand became 600 grand in this example. The first 4 years, if you're looking at the x-axis, the first 4 years, there's no income coming out. And your purple line, the 500 grand, grew up to a little over 600 grand. And there were no negative years, even though there may have been some market dips. There were no negative years. And then in year 5, we start taking income. Now that income starts, if you come all the way over here to this side of the picture, your income starts at about $35,000 a year. So just under $3,000 a month. Now Wall Street would recommend out of $600,000, what's the safe amount to pull out? About 18 grand is about what they would recommend. They would say,
is that based on a certain percentage rule, like 4%, or what is the current thing that people are saying?
The old rule was 4%. Back in the 90s, they would recommend you don't take more than 4% of your account balance. And if you do the math there, 4% is $24,000 a year. Now, with today's world, economic realities have changed, and retirement researchers like Dr. Wade Pfau and Dr. Michael Finca and David Blanchett from Morningstar, they all, and many others, are saying closer to 3% is safe. That's the safe withdrawal rate, 3%. So on 600 grand, what does that work out to? 600 grand, 3%.
That's 18,000.
18,000, like I mentioned. Okay, good. So $18,000. We're obviously taking $35,000 from this annuity. Which of those two numbers would you rather have? All right. So we're getting a lot more income with no market risk. And then things get really interesting. What do you notice about the blue bars? They're getting taller, right?
Mm-hmm.
That represents your annual income coming out. So after 30 years, there are some increases each year that the index is positive. So if you're watching the S&P 500 and the market goes up 5%, let's say, you'll get a pay raise on your income that year. So throughout retirement, as you enter your 70s, your 80s, your 90s, this guy's income went from 35 grand to 40 grand to 75 grand and even up at $90,000. And it would continue to increase for as long as he lives.
So the annuity the annuity company is investing the money in it one way or another in market activity as well.
They have their general account, just like life insurance companies. They have a general account that they put to work. It's mostly going to be fixed income assets like bonds and some high grade real estate. Now, if they lose money in real estate and bonds, whatever, they are obligated to protect your account. You don't lose money when the market crashes, as we've said earlier. Now, what they do if the market crashes, annuity companies purchase options against markets going down, so they can protect their downside through options. So that's where the annuity company is putting their money to work. Some people say, well, Mark, why can't I just buy the same bonds and real estate the annuity company is offering me? Why can't I just follow their methods and avoid all this annuity stuff? I'd go back to our previous conversation. Just tell me how long you're going to live, and I'll build you an annuity just for you, without any of this annuity business. No, of course, nobody knows how long they're going to live. Right. Using mortality credits, using actuarial science, something that Wall Street just doesn't have access to, you're able to provide this kind of an income far greater than what Wall Street would recommend, 3% versus much greater over here. One last thing I'll say, and then I'll hush. What's happening with this footnote D here? Do you see that? The purple line just craters as you go throughout retirement. So this guy is like 76 years old or something around here, 21st year after starting at 55. And his accumulation value has just cratered. It hit the curb. He's out of money. But David, do you notice his income that year? He pulled out a little over $60,000 in that same year.
So the blue line is the amount of money available to him if he should pass on or end the annuity in some way.
On this chart, it kind of looks purple to me. I don't know what color it might be on
Okay.
the screen there, but this accumulation value, this squiggly line here, is the
Hmm.
remaining lump sum. If he should cancel or walk away, or if he dies, he'd
Gotcha.
leave the remainder to his family. The kind of light blue color here, that's his annual beginning of year annual income withdrawal that he's pulling
Okay.
out of that annuity each year. So what
So
I'm showing,
after a while, there's no more option to take money out, but the payments still continue per the contract with increases over time as well.
that's right. Yeah. So you've got it. And even if he should pass away, his spouse could continue to receive the income for as long as his spouse lives.
Okay.
So I always say it's not about return on investment with annuities. It's about rate of income. Rate of income. That's my ROI, rate of income.
So it's really it's a way of turning um, sums of cash into these payments over time, and um, there's multiple ways to get that sum of cash to acquire the annuity. You can either do it kind of all at once, or you can build it up over time, as
Mhm.
in the example you gave with the business owner that was making the annual contributions. What what would you say is the most common way that you've seen these used with your clients?
Well, especially the business owners.
Yeah.
I think annuities are a great pension replacer. When I started my business, they didn't just hand me a 401k. Who were they? It was just me, starting my
Yeah.
business. Um, and typically, you want to have some kind of preparations for your own year when the revenue stops flowing in. I feel like most business owners are putting all of their energy and money and attention into their business. And while that's admirable and smart, because you have the most control over it, that is a one stock portfolio. And a lot can happen in your business. And it's one of the more risky portfolios I can think of. Um, if you're into weightlifting, the barbell has a weight on both sides.
Hmm.
You can take a lot of weight on one side, but it's hard to lift it unless you have an equal weight on the other side.
Yeah.
Similarly, with your portfolio, if you have a super high risk asset like your business or crypto or something else on this side of the barbell, on the other side of the barbell, you might have a giant whole life policy or a giant annuity or both that couples with your risk portfolio some safe stuff. And by doing that, you're able to lift more, you're able to push more, you're able to actually take more risk in your business. If you know you can fall back on a guaranteed lifetime income from the annuity or from your cash value whole life policy or both. This is where I'd say most people, I guess, bypass the idea of boring old whole life insurance or annuities. No, it's they work in conjunction with your
Yeah.
business. That's one example. One other quickly, and then I'd love to know your thoughts on this. Couldn't we use this as part of our buy sell agreements? Couldn't we figure out that, okay, I'm going to sell my business someday. I want to be paid an installment sale from the buyer, and I'm going to use that to fund an annuity. Or I'm going to take that money and fund a life insurance policy, which will ultimately transform into the annuity, such as the Bank on Yourself Plus strategy we talked about. So, just a lot of creative ideas there for how you might be able, or if you're buying a business, one more and I'll hush. If you're buying a business, couldn't you, and maybe you've got a bunch of money you can either pull from a savings account or maybe you get a loan from a bank or something, dump that money into the seller's annuity, and that annuity then pays the seller so you don't have to worry about writing that check every year. Just
Hmm.
thinking all sorts of options for folks that are in the buy sell arena.
Yeah, so I've had plenty of clients who are buying businesses use bank on yourself style cash value life insurance as a source of their equity down payment to do a deal. So I've had that happen over 20 times that people have mentioned it to me. I'm sure there's
Cool.
other times too where people just didn't explicitly tell me that's where the money was coming from, but it has worked well for a lot of people. When it comes to the seller's side, sometimes there's some seller financing component to the deal. That cash, what is the seller doing when they receive those payments? I mean, the seller could certainly decide to take them and use them as payments towards an annuity or life insurance too. Usually, the buyer's not involved in that kind of
Mhm.
conversation. One of the things that often does come up is if the seller is retiring, sometimes the seller will say, I don't want to do a big amount of seller financing, but seller financing notes tend to be at higher interest rates.
Hmm.
And so one of the questions I will often coach buyers to say is, well, if you got all the money today from selling the business, what would you do with it? It's hard to find a place where you can invest and get such a high rate of return as you can versus doing the seller financing. So this is another option though for the people that are tuned in who are business owners who may be asked to do longer seller notes. So sellers, again, because they're maybe afraid about collecting all the payments, they might insist on a very short amortization of the seller loan, which actually puts the deal in jeopardy.
Mm.
Because if the amortization of the seller note is too short, it puts a cash flow demand on the business, which may create problems for the new owner. If you agreed instead to a longer seller note, it's going to be easier for the buyer to make those payments. You're going to collect more interest over the course of time. And, if you're going to take payments over 10 years and you got into an annuity arrangement where you're going to make payments over 10 years, you could match these things up for sure.
I think the creativity is where really the satisfaction comes from. It's why folks love working with you and why you've been doing this for longer than most. There are a lot of fly-by-nights out there in your world, and my world too, in the financial world certainly. But your attention to outcomes and serving your clients well, it's just one more reason. I'm shameless plug to you, man, but folks should be working with you to get this stuff done. You only get one life. You only get maybe a business or two you can run in your life if you're selling. And you certainly don't want to buy some goose eggs when you're trying to invest in somebody else's business. So do it right. And there's lots of creative ways to do it.
Well, and Victor just put a comment here about hi David, thanks Mark. It's all about risk management, isn't it? And I would like to, you use the analogy of a barbell. And if you have something that's very risky, you want to balance that with something that is very low risk. Um, in in my online program, Business Buyer Advantage, I actually have a module on risk management where I show there's a tool from a 1950s central banker, John Exter. Have you ever seen Exter's Pyramid of Liquidity?
Yeah. Mm-hmm. Yep.
Yeah. And so it basically describes in a financial crisis how people try to change assets. So people that own one kind of asset might want to quickly sell that for a different kind of asset that they perceive to be more liquid. And so it's an upside down pyramid. And at the very bottom, he put gold because back in those days, the currency was backed by gold. And so he talks about all these different levels of assets, and it's the very topmost layer of his pyramid, the very riskiest layer, is for the ownership interest of privately controlled, non-publicly traded companies,
Mm-hmm.
which describes all the small businesses that people might own that are tuned into this show today. It's a highly illiquid asset. Sometimes when you decide to sell a business, it can take years to sell, literally. And market conditions are, in a lot of ways, outside of your control. People that have a more discretionary product or service, with things like inflation going up, causing the price of fuel and food to go up,
Mm-hmm.
people are going to have less money for discretionary spending. You could run a really great business and do everything right, but if the customers literally don't have the money to consume your product or service, you're going to suffer. And so you've got competitive issues going on, you've got regulatory issues going on, you've got macroeconomic issues going on, all kinds of things outside of the control of your small business. I'm always telling people, when you're making money, take chips off the table. And what Mark is talking about is an opportunity, exactly what I'm saying. Like, get your money out of your small business, go invest in something else that's completely uncorrelated, unrelated to what you do in your business, so that if something bad happens and the business ends up, having to close, you still have something. There's still the fruits of your labor parked somewhere safe, right?
Yeah.
And one of the things that I like about Bank on Yourself Insurance is that in most places it's creditor proof. So is it the same with annuities?
Well, there's something that I would say, yes, you want to make sure you're working with the right companies. And as far as risks or problems or what can and can't, I'm going to point people to what's on the screen here. David, if you wouldn't mind, I'm going to share my screen one more time. There is a special report I can give to anyone who goes to newbankingsolution.com. And Pamela Yellen has put together a guide to guaranteed lifetime income that I think more closely approximates the reality than anything else I've ever read about annuities. There's plenty of stuff on the internet. You can find an opinion for almost anything you want to find on the internet. There's probably groups of people out there who hate, puppies on the internet. There's different opinions for everything on the internet. Annuities is no different. Whole life insurance, certainly. Buying a business, I'm sure there's people who would tell you that's all you should ever buy, and others that say never do it. So annuities, I think, come with all their certain baggages. There are various types of annuities out there. This simple chart will help you know what types are typically encouraged for certain strategies like we're talking about today. There's lots of vocabulary out there on the topic of annuities and whole life insurance too, for that matter. Most people I talk to are wanting to, reduce their fees in the market. They're wanting to reduce volatility that the market has provided for them. And oftentimes they end up with their buddy from college or their uncle who sells them some kind of annuity that can lock up their money for decades or more with long surrender charges. Or maybe it's still a variable annuity, which means it's still tied to the market's ups and downs and fluctuations. In fact, I regularly see, David, variable annuities costing people not just 1% a year fees, like is typical with most market-based, IRAs and 401ks, but variable annuity sub-account fees can approach 4% per year, which is egregious. So I stay away from the variable with all gusto I can find. But you can sort of see that you can either have a immediate annuity, which turns on income today. So if I'm selling David my business today, 2 weeks later, I could be getting my first lifetime income paycheck from my annuity. Or I could choose a deferred annuity. That's one question you want to have. One, is it safe? That's the first question. Is it safe? If it's not safe, that's a variable annuity. If it's safe, yes, then that's called a fixed annuity. The next question is, when does my payment begin? And if it's going to happen right away, that's an immediate annuity. If it's going to happen later on, like that chart I showed earlier, he was going to wait 5 years. That's called a deferred annuity. And then finally, is it going to grow at a determined rate, or is it going to be changeable? A fixed declared rate annuity might, these days, right now, they're doing pretty good. As of this recording, they keep up and mostly beat what CDs are offering, fixed declared rate CDs. So like, you might choose to get a 3-year or a 5-year annuity that only lasts 3 to 5 to 7 years, let's say, and then you get your money back. That's called a multi-year guaranteed annuity, or MIGA. Sorry for all the vocabulary here, but think of it like a CD, but without all the problems of CDs, like taxing you every year. There's no taxes due on MIGAs every year. Okay, so those can approach and even beat what CDs can offer. And then finally, the fixed index annuity, which is what we spent some time talking about today, where it's growing according to a certain market index, but it's not in that index. I want to be very clear. You're not actually investing in the S&P 500 when you get a fixed index annuity. You're simply watching it from the safety of the annuity company. Best way I can describe that is, right now I'm in Chicago. I can look up the heat index in Phoenix right now without living in Phoenix, right?
Right.
So we could enjoy the comfort of our little, town here in Chicago without living in Phoenix, but we can still check the index. And that's what the indexed annuity is doing. It's watching the S&P 500 without going through all the gyrations and volatility of the S&P or other index. Any comments, questions on this chart, David, as I see our time?
Well, no, it shows me that if I was, when I reach the point where I might want to do this, it just sort of highlights the fact that you need to speak to someone who understands these products and works in this world every day, because there's just so many options out there that you can get into. And I put the website up there. It's newbankingsolution.com, where people can go watch the old videos about where Mark has appeared on the channel, and watch the webinar about Bank on Yourself. But this is also where people can book that 15-minute consultation with you. And listen, if you're out there watching this, or if you're listening to it after on a recording, if you are interested in learning about this stuff, if you want to put together a real plan for not only having better liquidity in your business, or for becoming more liquid in order to one day do a business acquisition, or if you're a business owner and you're trying to plan what life looks like afterwards, learn about these tools and learn about how they're going to fit with your specific situation. As I mentioned before, because some of these things are based on insurance, even if you're younger and you don't think you have the cash flow, or your business is newer and you don't think you have the cash flow, it still makes sense to have this conversation, because um, you may end up, for example, getting a term policy, which is not the same as what we're talking about, but it locks in your insurability for the future so you can later convert it. So time is of the essence. It's better to spend some time investing in this stuff, investigating this stuff now and creating your plan, than it is to wait, because if something changes in your health, it can close a lot of doors to some of these opportunities.
Yeah, well said. It's the old phrase, you talk to the elders, they got the watches, but the young folks got the time, and with annuities, there is no medical underwriting. And you're right. There's so much that we can discuss, and there's just not enough time. But I think, David, you've given us a great overview, and thank you for great question and answers today. To look at something that's 2,000 plus years old, and it's provided the peace of mind that comes with what we've been describing today. Do you think it's worth at least 15 minutes to evaluate it for yourself and for your business? I'd say yes.
Yeah.
Don't just work with anybody. Work with someone that knows what they're doing, and speak with David, speak with myself, and we can see if this is the right fit for you.
Awesome. This has been great, Mark. We're going to wind things up here because we're approaching the top of the hour. But I would encourage everyone. There's your partner in crime there. Don't wait.
All
Start
right.
now. I would encourage everyone to go to the website newbankingsolution.com, book the appointment. And Mark, thanks so much for stopping by here today. It's great to see you again.
Always great to be with you, David. Anytime, man.
All right. We'll see you next time. So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally, and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.